Hello.
Hi, how are you?
I'm good. How are you?
I'm good, thank you. I'm just figuring out how to turn. There we go. Hi.
Hi.
I'm gonna also just make sure my slides are gonna work. So just give me a minute.
Sure, go ahead.
I just wanted to double check. Can you see my slides?
Yes, we
Just to,
can.
and then I just want to see if I present, it's okay.
Yes.
Okay. Okay. Brilliant.
Okay, good afternoon, everyone. Welcome to today's financial literacy webinar by Radhika. We've been waiting for this webinar, of course, since the month started.
Thanks, Shannon. Thanks, Annie. So I hope you are, ready to learn something about financial literacy. I'm excited to be here, and feel free to unmute your mic at any point if something doesn't make sense. But hello, everyone. My name is Radhika Bhachu, and I'm the co-founder of Ndovu. At Ndovu, we empower the everyday African to take their hard-earned money, invest it responsibly in local and global assets so they can achieve financial freedom. And today I'm sharing a plan here that I think you need to follow in order to be financially free. And financially free means a lot of different things to different people. But to me, financially free means that I can get up and work and do the work that I wish to do. I don't have to go to work. I don't have to generate income. And again, that number is very different to very different people because we all have different requirements. We might have families, children, we're looking after an elderly member. Sorry, there's a fly here. And the idea here is that I'm going to give you the tool and tool set to be able to understand what are your financial free numbers, and then how do you help your money that you're earning today invest it responsibly so you can achieve financial freedom. And feel free to unmute the mic should you have any questions. Okay, now I'm sorry, I'm just figuring this out. I thought the slides would move with this. Just one second, I have to go to the other side. Okay. So for the agenda today is for me to share how to build a strong financial foundation, teach you the difference between saving and investing to achieve financial freedom, and then a step-by-step guide, and then we can do a Q&A session. So I'd like you to meet Mary. Mary's a millennial. She's works hard and lives in the city. She's definitely a Kenyan, but she's a global citizen because her skincare products come from abroad, and her laptop, her phone, technology is coming from abroad, and also because of social media, she's very much in touch with global trends. She is in her 20s, and her goal in her 30s is to be married, build that dream house, but also be able to enjoy her money and travel the world. And right now, she's making 100,000 shillings per month net. And that's basically the use case I'm going to use today to help you understand, just so it's more granular in terms of numbers, how to manage your thing. But the thing about Mary is that she doesn't actually have a financial plan. So it's really interesting. Before we go to school, we figure out what our career plan is going to be. When we're in work, we know like, okay, this is where I'd like to get to. This is where I'd like to achieve growth. In my career, this is what I want to do. But actually, when it comes to money, we're not taught about money management. We're not taught about creating a financial plan. And if you don't have a plan to fail, you've probably heard a very famous saying, and it's true. And so, what a financial plan is, it's an approach that helps you achieve your short term and long term financial goals. But financial goals are actually dreams. So, how do we put a plan in place for you today to understand how to achieve your dreams? So the good thing is Mary worked with us, and we helped her understand what her net worth is. And typically I normally ask people on the call, like, how many of you have know how much money you have in all your investments right now? And typically what happens in a room, only 20% of people actually know what their net worth is at any given time. But my advice to everybody is that you should be thinking yourself as a business. And if you're a business, you should know how much money you have in your bank account. That's liquid cash, but also what your investments are. And also, what are your liabilities? What are your outgoings? And how do you make that? So that's in a business sense, but how do you make that applicable to you as an individual? So on the asset side, I need to know how much cash I have in my bank. I need to understand the investments I have. Have I made land, invested in real estate, unit trust? And it's good to have the value of it somewhere. But I also need to know what my outgoings are. So what are my liabilities? Do I have have I got a loan for buying a house or doing a construction? Do I have any other credit card debts or short-term lending loans? Am I overspending? Like, what are my expenses? Am I spending more than I'm actually earning? And if you understand both of these aspects, you then are able to have a very clear path of what your net worth is. And so I would like to explain the difference between good debt and bad debt. Debt is a really good tool. So debt is where you can borrow money from a third party and pay an interest over a period of time, so you can use that money to generate income. That is a good debt because it's generating income. So let's say we invested in a business and you took a loan out for that and it's generating income. That's good debt. Another good debt is you bought a house and it's going to be your long-term dream house. That's good debt because it's an asset that eventually will appreciate. Let's say you bought a real estate apartment with a bunch of friends and it's generating income. Great. But what is bad debt? Bad debt is when you borrow to go on holiday. Bad debt is when you borrow to buy a car. Bad debt is when you borrow to, nowadays you can buy now, pay later on so many other things. Those are bad debts. And the definition of a bad debt is if you're paying more than 12% in the interest rate that you owe back on any loans, that's a bad debt. Because in Kenya or wherever you're all from, the average interest rate you earn from a money market fund is anywhere from 10 to 15%. So ideally, the goal is that we would like, if anything, as a first step, is A, to understand what are your outgoings, B, what do you have debt? Is it good debt or bad debt? And then lastly, what investments do you have? So we can put together what your net worth is. Okay, so today I'm going to take you just through some financial rule of thumbs that you probably have heard of, but it's always nice to hear again. So you should never spend more than you earn. You should always look to live within your means. And what happens with social media and keeping up with society, you end up sometimes spending more than you can in a particular month, and that's a very dangerous, slippery slope. And the idea is that we want to make sure we understand how much we can spend. But in order for you to do that, you actually need to understand what your net worth is. So what are your outgoings on a monthly basis? What is your rent? How much does it cost you to go to work? What are my monthly utility expenses? This is how much I need to eat out, etc., and go out. And so if you know all of that, you can then actually never spend more than you earn because you now understand how much you have. The second one is limit your housing cost to 30% of your income. So let's just say on a monthly basis, you're earning 100,000 shillings. You should not be spending more than 30,000 shillings on income. I know that feels really small, but that's just an example we're using. But honestly, I personally think if you're spending more than 30% of your monthly income on rent, that's silly. That means you need to downsize, you need to get a smaller room, maybe for a short term in 3 to 5 years, stay with your parents. And there's nothing wrong with that because you're setting yourself up to be financially free, and I'll show you how. But you should not be spending 30% of your rent at all. It's a bad idea. And it's not a smart idea either. Of course, we talked about bad debt. We want to pay off all bad debt because you can never outpay bad interest. So the idea is that if we have any short-term loans or we owe people money, let's put a plan in place to make sure you pay that off in a reasonable timeline, 6 to 12 months time. The other thing is that know the value of every purchase. So I think this is something I've been doing recently is when I'm about to buy something and I put it in my basket, I ask myself, like, do I really need this? Can I do without it? And typically the answer is yes, you can. And so you need to understand just for a short period of time. I know we all want to live life, we want to enjoy life, but for a short period of time, if you make sacrifices on do I really need this or is this a want, it will help you get to a place where your investment is now generating an interest, and you don't really have to think about do I really need this or want this, because you could use your interest being generated from your investments to achieve to buy the things that you want. Number 6, an emergency fund. A lot of people are familiar with emergency funds. This just means that you should have 3 to 6 months runway of your living expenses in a bank account. It can also be in a money market fund because it's great to earn a great interest there. And it's something that you should always have. So before you go ahead and build your investment portfolio, my advice to everybody is let's start with 3 months in a money market fund. And thereafter, as you're building your investment, you can build the rest of the 3 months also in your emergency fund. And then lastly, we as Africans have learned how to save, but savings are not investments because savings don't earn typically more than the inflation rate and the cost of living going up. And so you must invest. We think we're doing a really great job by saying, oh yeah, I save every month. But just making a small decision of moving towards investment puts you in a much better financial position than saving. And why is it important to invest? Because investment actually takes you to, it's the bridge to financial freedom. So what does that mean? It's the tool that you can use to actually be financially free, so you don't have to go to work. You choose to go to work. And just having that freedom of saying, actually, I'm going to do something that I'm really passionate about, because money isn't really the object, is a really empowering feeling. And in order to get there, it does take 5 to 6 years of hard sacrifice and being really mindful of how you're thinking about the money that you're earning. But in the long term, it is a really important tool to have. The other thing is, when you invest, it means that you can accelerate your financial goals. When you're investing, your money's growing faster and you can reach your milestones much faster. I mentioned about the freedom of choice, but also it helps you achieve the dreams that you want to achieve. And so you're no longer a slave to making money. Money is working in your favor. And I strongly do believe that actually giving yourself or your loved ones the gift of being financially free really does change the way you think about yourself and money in the long term. So this is a really probably a very contentious statement I'm going to make, but the local market here has communicated money market funds to be investments, but they're not investments. It's a simple savings tool. So when you look at a money market fund, you can see that we have one at Ndovu. It's generating 13% this year. To be honest, it's an average, industry average, so it's not like we're blowing the lights out. And actually, if you have a money market fund that's doing significantly higher than what the market is doing, that's a red flag, because these products are designed only to outpace inflation and preserve capital. So what do I mean by that? I mean that, okay, if the average inflation rate in Africa is 5 to 7%, the money market fund should at least generate 5 to 7%, but then also look at generating something more than that, so that you can actually keep up with the cost of living going up. So when I say cost of living, you would have noticed that to book a flight before COVID was relatively affordable. When you go out before COVID, it was like relatively affordable. But since COVID, the cost of living has risen by 30%. So the same thing that you would have bought 5 years ago is now 30% more expensive. So when I go out for dinner, instead of spending 1,000 shillings, I'm now spending 1,300 shillings, as an example. Don't get me wrong, I think money market funds are very good for your emergency fund. They're easily liquid. You can put in small amounts of money that you have just sitting loose change, which is also really nice. But the thing is, it is not an investment. And this is why it's really great for us to build your emergency fund in a money market fund and then focus on investments. Now here I just want to show you the importance of savings and investments and what it actually means and what it could mean in the long term. I think the problem we have typically is that as individuals, when you're spending the 300 shilling on coffee every single day, that 300 shilling feels like 300 shillings. And as human behavior, you also would spend you also don't compound the amount that you're spending. So for example, spending 300 shillings today, you're like, oh no, it's not really that much. But if you were to spend 13,000 shillings, you might be like, oh, actually that's a lot of money. I'm going to think twice about it. But actually that 300 coffee that you can buy from Java, if you bought it 5 times a week, for the 12 months, that's actually 150,000 shillings worth of expenses that could have been investing. And the smart thing you could have done is just make your coffee from home and carry it in a to-go cup. And it's those small changes that won't there's lots of social media going like, oh, why would you forgo your amazing coffee? No, you shouldn't forgo your amazing coffee because you're not in a strong financial position yet. And yeah, when you get there and you're financially secure, then yeah, you can buy coffee here and there. And it is the small sacrifices that make the difference. And this is the reason why. So I'm going to take you through this example here. Let's just say we're taking Mary as an example. She's earning 100,000 shillings a month. She's saving 30,000 shillings. And if she's earning, she thinks she's doing a really, really good job and she's saving. She's saying, yep, every month I'm taking money away and I'm putting it in my savings account and I'm earning 3%. Wonderful. In 10 years' time, that 30,000 shillings would be about 4 million shillings. But if she was smart enough and just put it in an investment, it would be double that. But the thing is, again, these are small amounts, so it doesn't really feel like a lot. But imagine when you get to a position where your salary grows, you are, in your now 30s, you're growing, your salary is higher, and you're now able to save, let's say, 100 to 200,000 every single month. If you were to just save the 200,000, you'd be at 28 million. But if you had invested, you'd be at 56 million. So the difference almost is twice the amount of money you would have made by just making a small decision of saying, I'm not going to save, I'm going to invest. And the reason this happens is because when you invest, your investments generate interest, then that interest generates more interest, and that's the power of compounding. Whereas with savings, you only earn interest on the principal. So you don't earn the interest on the interest and the interest. And I'm going to be completely honest with you, being able to achieve financial freedom is a 6 to 8 year process. But let's ask ourselves, how quickly has this year gone by? So it might feel and sound like a long time, but actually, I moved back to Kenya in 2020, actually 2019, and I can't believe it's been 6 years. And that if you just build those very good behaviors, time really does fly. And if you look at like higher value, longer period of time, the best advice I can give someone is that when you're in your 20s, if you build good investing behaviors, you don't have to worry about your financial retirement. And good investing behaviors are saying that I'm going to religiously take a proportion of my salary and invest it responsibly. And you would never have to worry about your retirement. And actually, so this deck, was actually recently created. We spent a lot of time with our customers. At Ndovu now we have over 200,000 customers, and we speak to them. And a lot of them we realized didn't have a financial goal. So they have a financial goal, like I would like to buy a house, or I would like to travel the world. I would like to buy that dream car. But what they didn't have was the numerical value of what does it actually mean to buy your dream house. And what we realized is that we have a subset of very varied clients, and some clients are starting off on their journey. And for us, the first goal for them is to get them to having their first $100,000, which is roughly 13 million shillings in Kenya. And then we have some other clients who are now in at like $500,000 target, $1 million target, but they're slightly more senior in their careers as well. But I didn't know the audience today, so I've just given you I will talk more and focus more on the first milestone. And feel free to reach out afterwards if you want to talk about how do we get to now the next milestone. But the reality is, and I recently did a podcast and I got a lot of backlash. The reality is that if you don't have 13 million shillings in an investment account, why are you living your soft life? I got a lot of backlash for that. I don't know if you guys have seen that, but it was saying that, does that mean we don't enjoy it all? No, that's not what I'm saying. I'm saying we need to make sure that you have a plan to get to 13 million shillings or 100,000 shillings in an investment account that is earning on average anywhere from 15 to 20%, 25%, whatever we can deliver, so that you can become financially free. And that really is a really strong number. So if you are single and you don't, so we did the maths in such a way that if you're single and you don't have kids and additional responsibilities, the money that you earn, let's say 15% off 100,000 is $15,000. $15,000, so it's a little bit 150K roughly month in Kenya shillings. You as a single individual don't actually have to work because you've got investments that are generating you enough money so that you can actually do things that you want to do. And that's where the $500,000 comes from, so about 50 million shillings, because that is now, sorry, does anyone want to say anything?
I actually think someone came on the stage.
Oh, okay.
Yeah.
Okay, I'll just continue. Yeah. So the idea is that, like, how do we ensure that we help you get to your first milestone? Now, the reason this is really important is a couple of things. So you may have heard of the psychology of money. And there's a lot of systemic issues, even like growing up. If kids who come from business families think like a business themselves, but kids who come from working parent families, they think very much like a working class family. And so there's lots of things around the psychology of money. And what this milestone allows you to do is, number one, if you were to earn 15% on $1,000 versus 15% on $100,000, the size is obviously much bigger. And what that does is when you hit that threshold, you start understanding like, oh, I now have confidence. It's like a tipping point that, oh, I can achieve my next milestone. And one thing I want to tell you is that getting to this milestone is much harder than getting to your next milestone because of compounding. So it's much easier to accumulate wealth once you pass this $100,000, 13 million shilling mark, because your money then starts generating and growing at a much faster rate. And we are working with a lot of our clients now to get them to this goal so they can start to be financially free. And some of the things they might do is that instead of taking 3 holidays a year, typically what happens in a year is that you'll do a trip locally. That still costs money, about 50,000 shillings. You will take one trip abroad, which will be about 200,000 shillings. And then you'll do another local trip. It's like saying, okay, in the year, we're only going to do one trip, and the rest of the money we're going to invest. A big thing we've learned from our clients, people love to eat out. I don't know what it is in the Kenyan culture, but I've done some financial advisories with some clients, and they're spending 50,000 shillings a month on takeout. And sorry, this does include going out and things like that, but I always use it from so the thing I normally say is that, if you cook at home, you tell your friends to come over, it doesn't have to be, everyone can bring a potluck, whatever it might be. You could go for a walk instead of saying, let's go for brunch. You do a quick walk, grab a coffee on the go. You've still done the same thing. You've seen your friend, you've gossiped, you've, exchanged business ideas, you've done everything, but at a much lower cost. And it's just, until you don't hit this 13 million mark, there's some sacrifices we have to make. And it's not going to be easy, but thereafter it will get much easier. The other thing is also looking at ways of increasing your income. I think that's really important, but also really asking, going back to those financial tips, do I really need this? Is this a want or a necessity? And I'm not saying, sometimes there are wants that you would want to do, but then you have to sacrifice on not so much of a want, if that makes sense. But essentially the idea is here that we need to help you get to this milestone so that you can be financially free as an individual. Okay. Now, this is really great. Now you have a plan. You're like, right, I'm going to go back, and I hope you're taking notes, is that you're going to go back, you're going to look at your monthly income, what is coming in, what's going out. Please don't spend more than 30% of your housing. If that's the case, you need to downsize, and it's only for a matter of 5 to 6 years. I know it feels like a lot, but you'll be thanking yourself later when you have interest coming back and giving you money. Understand what your outgoings are. Do you have any bad debt? And just understand what your net worth is as a whole. So it's really great. I've told you that you should be saving on average 20% of your salary every month. You must have an emergency fund, and it should sit in a money market fund, whether it's with Ndovu or any other money market out there. And the idea there is that you should have at least 3 to 6 months runway. Even if you have 4 months to begin with, that's okay. But it should be generating more than 3% that you get in the bank, and it should be generating an average return. And then now we're going to come to investing. Now, investing, it seems like this really daunting mountain to climb. It feels like Mount Kilimanjaro or something, but the idea is that actually investing can be very simple, and I'm going to take you through different types of investments and why each of these investments are good. And then I'll take you through if you're going to think about investing, especially in this day and age, where you should be putting your money. So number one is real estate. So keyword here is real estate, not land. We again have loads of clients who come to us and say, yeah, I've got 10 million shillings in land. Great. Is it generating income? They're like, no. Can you sell it? No, I can't sell it. Okay. How do we get you to your 13 million shillings? And so now some of our clients are actually offloading land because it's in a completely remote area. They have no plans to settle down there, but it's not generating any income. And a lot of Kenyans, our parents love to tell us to buy land. The other real estate that I'm really interested in about is real estate. So owning an apartment that generates income. And as long as that income is paying off your apartment and covering the expenses, in terms of the mortgage and the rent that you're earning is covering that, then it's a good investment, very good investment. And in your overall investment portfolio, you should have an allocation of 10% to real estate. It adds very good diversification as well. The second thing is bonds. Bonds are low risk. They're offered by governments and companies. So what a bond simply means is the government will say, I'm going to borrow 50 million shillings and I'm going to give you an interest of 12% every 6 months. And at the end of the 20-year period, you'll get your principal and the interest back. And we're going to use this money to build infrastructure around Kenya. Yeah, it's low risk, it's backed by the government, it's likely you're going to get your money back, it gives you regular income, and typically bonds are known to be low risk. Bonds are actually quite complicated. Within that, there's different levels of risk bonds, but typically government bonds tend to be low risk. And again, your low risk portfolio, depending on your age and your circumstances, should on average be around 15%. So this is fixed deposits, bonds put together. And then you have things like equities. Equities is like you go out in the market and you say, I'm going to own a piece of that company. So it's called a share. And you're going to say, I'm going to buy shares in Safaricom. But the thing about shares is that you have to manage them yourself. You need to be keeping up to date with, is Apple doing well? What are they doing? Has their revenues grown? What is going on? And in my opinion, buying individual shares of companies is great if you are a seasoned investor. But if you're starting off, I would stay away from them, because the reality of them is that you can't predict what's going to happen to the value of them, because we don't have the time, the skill set, or the knowledge to be able to do that analysis on our own. And lastly, my most favorite one is known as funds. So funds are amazing. They confuse everyone. So there's mutual funds, there's unit trusts, there's exchange traded funds. Simply put, all of these different names do the same thing. A fund is a basket of securities or shares or companies that are managed by a professional, and they're liquid, they're transparent, and they generate income for you. Now, a lot of people will say, oh, what's an exchange traded fund? What is a mutual fund? What's a unit trust? Actually, all of them do the same thing. The best way I like to describe them is think of a Samsung, a 2000 Samsung. I don't even know. I am an iPhone user, but I know a lot of people use Samsung. So it's like a S2 versus an S7. They do exactly the same thing. You can make calls, you can surf the internet, etc. But they're just a better version. So recently, exchange traded funds are more tax efficient, they're more liquid, and they're the newer wrapper, the new version of funds. But in a nutshell, funds are managed by professionals, and that's the best way to actually invest your money. And what happens is when you invest in a fund, if it's a passive fund, like the money is just tracking the market, typically the returns on that have done really well. Yeah. Okay, so now before I move on, there are different types of investments here. Bonds, real estate, money market funds, they fall under here. Money market funds, Apple, Microsoft, Tesla shares, individual shares fall under here. And now I'm going to take you through different types of funds and why it's important to hold them into your portfolio, because the goal is that when you're investing, because this is your life savings, we're investing for the future, we want to invest your money responsibly. Now, the beauty about Ndovu is that there will be an RM that takes you through this throughout the entire presentation. So they'll actually speak to you on a personal level and say, hey, what's your income outgoing? How much can you put away? Okay, what are your financial goals? Are you risk seeking, not risk seeking? So they spend a lot of time, and I've just done this in a bit of a quick rush hurry because I'm conscious of time. But the idea is they give you a full plan that you can then follow. But within that investment plan, they will always have something known as commodities. So commodities are simple things like sugar, rice, oil, gold, copper, silver, and the likes. Commodity as an asset class is a really great asset class to hold, because a commodity means it's a necessity and we will always need it in the future. So whether it's cocoa, oil, sugar, agriculture, we need that to survive as human race. And then, of course, for all the technology that we are, embarking in terms of AI, we also use gold, silver, copper in the manufacturing of that. And actually, commodities are very interesting funds to hold because it diversifies your portfolio. So what do I mean by that? So typically, historically, when equities go down, so when companies perform badly and the stock prices come down, commodities act as a downside protection, meaning they will be going up because a lot of money flows into commodities. And that means that if you hold, let's say, 10 to 15% in commodities, it gives you some downside protection when the equity market is coming down. And just remember, with investing, the function of a stock market is that it goes up and it goes down. It goes up and it goes down. And the idea is that we want to make sure we invest in companies that are moving up and down, but are moving up and down towards the right. So the value is going up. And that's the value that we bring, of course. at Ndovu. But commodities are very good to hold, and they're very stable with nature over time. And you can typically expect a return of anything from 8 to 12%. This return is outrageous. Last year, gold did really well, silver did really well, and the reason is that U.S. Trump trade China war, so lots of money poured into gold, and that's why it's demand and supply. If a lot of money is going into gold, the demand goes up, so the price goes up. With silver, it's been used in manufacturing. There's also copper. And again, the idea is that, now that we're moving more towards technology and hardware, etc., they make components of different types of technology products. So now we have global funds. So here we are looking at different types of ETFs. So again, you can find a fund locally in Kenya that has equity shares like Safaricom, Telco, EBAL, NCBA, etc. But you can also participate in the global market. Now, I'm more lean to the global market is because even though we're Kenyans and we earn in Kenyan shillings, we're actually, our spending of especially large items is pegged to the American dollar. So when you bring in a phone, a laptop, etc., yes, we earn in Kenyan shillings, but actually the price is determined by the US dollar. And I highly and strongly recommend that if you are in Kenya, you should also have a USD allocation. And I always say that you can never time a currency. When I was at BlackRock, we had like the most brilliant minds working on currency, and they could also never time it right. So my advice is that if you're going to hold in a USD, just make sure it's an allocation of 50% Kenya shilling, 50% US dollar. But within the US dollar funds, there are so many different funds. But I'm going to spend some time here talking about the S&P 500. So the S&P 500 is basically a fund that holds the 500 largest companies listed on the global exchange, so the New York Stock Exchange. And in this particular fund, you get exposure to the banking sector, healthcare sector, FMCG, technology, you name it, AI, deep quantum mechanics, etc. So this particular fund is saying that if you just put your money here and you invest it, is anyone asking a question?
Is there a question?
It's fine, I'll continue. I don't think there is. Okay. The idea is that if you hold this fund, you get access to the entire market, and the average return on the S&P 500 over the last 5 years has been on average 16% year on year. And you're earning in dollars, so you're also, when our currencies depreciate, the African currencies, Kenyan shillings, you're also earning on the upside because now you're converting your dollars back to Kenyan shillings, so you're also hedging against movements in currency. And so if I was today, I was going to say to you, like, is there one fund you should hold that is low risk? In my opinion, it's the S&P 500 because it has exposure to every single sector you can think of. But the thing is to say that, okay, not all sectors are created equally. We don't know if the financial industry will continue to grow as quickly as the AI industry. Or we know healthcare is a necessity, but maybe the innovation isn't happening in the healthcare sector. It's happening more around blockchain. And then we look at things like to say, okay, well, if technology is going to go ahead and grow in terms of the growth of the market, and AI is definitely pushing technology, then maybe we want to look at the raw materials that go into building tech. And that could be things like semiconductors or microchips that are put into every phone, every computer. So we should hold that as well. And the beauty about investing in global funds is it gives you diversification. So you're not impacted by, your income's not impacted by things happening locally in Kenya. You're investing in the largest companies. All of us are already buying their products like Samsung, Apple, HP, but now you're actually ownership into those companies as well. They historically have had very strong returns. They're good reliance to reduce risk. In our terms, it's currency risk that is a big factor that we reduce. And then it also allows us to give us, as all of you on the call today, how many of you believe that in 20 years' time technology will still be around? I'm sure all of you do believe that. And if that's the case, why are we not investing in tech? So the important thing here is that, okay, how do we be part of the growth that's going to happen in global markets? How do we participate in that? And how do we get our money to make us money whilst we sleep? So yeah, so that is a bit about global funds. And then of course shares. Now these are for more seasoned investors high as well. So there is a place for shares, but my advice is that's shares. But when it comes to choosing an investment partner, it's very important to recognize that they're regulated. Does it mean to be regulated? It means because of the way the financial industry is set up, when you're regulated, you have to use a custodian to be a safekeeper of your client's assets. So if a company is regulated and they've got the symbol from the regulator, you know that at the very least your money is being held separately from the operations. So in that case, in an event that an investment company goes under, you can get in touch with the regulator who will say, oh yes, this particular investment company was using this custodian, and they will get in touch with the custodian and say, okay, so and so, these are the details. They have this much investments with you. What can we do with them? So in Kenya, we use DTB and SBM, and in the US, we use Saxo Bank and Interactive Brokers. And yeah, the idea is that in an event, should anything happen, your money is kept well. And then this is the team, and I'm just going to actually pause there now for any questions.
I don't know how soon anyone's going to jump in, but while you're getting unmiked, what is the least amount of money that anyone can invest? Because I think that people have this like fantasy, or not even fantasy, this unrealistic fantasy of I need to have like this huge amount, and it doesn't take that, and you have to start somewhere. So, what do you recommend?
Yeah, no, I couldn't agree more. So actually, that's one of the reasons we set up this company was because in Kenya, if you're wealthy, you have a private banker, and so that means that with a private banker, you need $10,000, 1,000,000 shillings. But what we have done is we've democratized access to financial markets. Because actually, I truly strongly believe that actually our vision is on here that in the next decade, every African will be an investor in capital markets, even if they don't realize that's the product they're using. And so the way we do it is to answer your question on ETFs. So you can invest in some products with as little as 500 shillings, and some products, the shares are 1,000 shillings, and then the funds are 5,000 shillings. So you can get started with very little money, and that also gives you the opportunity to also test it. So if you're comfortable with it, you can then get familiar with it and keep investing. So I think that's a really important thing. You can start with as little as money. So just think about it. You're going out for dinner on the weekend, and you're like, oh, I'm going to spend 5,000 shillings. Actually, I'm going to save 1,000. I'm going to invest 1,000. I'll keep my budget to 4K. Just in as like real tangible examples of how I would start investing if you haven't done it before.
One more question that I have. I'm sorry if I'm dominating once again.
Sure.
So we have the African women in tech community, and I was wondering, like, would it be a good idea if we said, let's do an investment club, so that we can get women going? Like, once we get that going, would you be willing to come in and, you know?
100%.
Okay,
Yeah,
good.
100%. Yeah, so we actually just a bit of information. We actually work with 173 investment clubs at the moment.
Oh, okay.
So we can share tips and what they do, and actually all of you could be users on the one account, so you can all see it. You won't have actions, but because there'd be an administrator, but you could see how the money is growing over time.
Oh, I love it. Okay, no problem. We'll get that started.
Sure. Caroline, I think Caroline wanted to say something. Okay, Annie, I guess if there's no other questions, yeah, what do you recommend?
Okay. So, what I recommend right now is that what it is I feel like it's so new to our community because we have financial literacy background and we only touch point. So, what I want to do is, like, of course, start the investment club. This way, we can get our women to understand that you don't have to have huge amounts of money. And if we do it as a community, it will strengthen what we're able to do. So, the first thing I need to do is go back to the community and make sure that we're all understanding why investments are important. And if we pull together, it makes us stronger. But if we stay as an individual, we might see it as such a big thing and we just don't have the funds. I
Yeah.
know a lot of unique organizations in the US have started because they pulled their resources together. So, and that's where I recommend that we go moving forward so that, when we have sessions like this, we know that, they've gotten the basics in their understanding. So, and you've been super helpful for us. I know that there are other questions from the team. I don't, Shannon, I think you might have had a question.
Okay, so I wanted to ask if you're looking for a place to invest, what are some of the red flags you should look out for on potential scams?
Yeah, great question. So firstly, okay, good question. So firstly, if it's too good to be true, it is too good to be true. So this is where education comes in. So so money market funds as an example, I'll use it as an example because they're quite popular. If majority of the fund managers are giving you 12 to 13% or 15%, and somebody's promising you 24, that's a red flag. So when the return sounds too good to be true, it is. And trust me on this, I've been doing this for many, many years. It is a scam. When it's too good to be true, it is a scam. So if somebody comes to you with a deal and says, listen, overnight you can make 3,000% return, it's a scam. Trust your gut. And the other thing I always say when it comes to investment, if you don't understand it, don't invest in it. Because that means that even if it's not a scam, because you don't understand the way it works, the experience you're going to have is that it's a scam. Thirdly, please check if they're regulated. So my advice always is see what certifications they have. Having that regulatory stamp is really important because it gives some level of security that at least they're doing something in line with the regulator. And lastly, I will say is that whenever you invest, try whichever investment it is, always try to take some money out so you understand the process. So this is less about the investment being risky, but just so you understand the process, so um, you don't have a bad experience that in an event that you need your money, you misunderstood it that it's immediate, where it takes 3 working days. So I think that's a really, really important point. And then lastly, find out who else is invested in it. Have they done their homework? But the thing with investment scams, it's typically herd mentality and people are trying to get you in. But just use your own common sense. Nowadays, you have Chat GPT, you have the internet, Google it, understand it, research the people behind it, and then make your decision. But the advice I will give you with a rule of thumb, like it's not rocket science. If somebody is promising you more than market return, that's a scam. Because how are they making the money? What, they don't have a secret source. What is the secret source? They don't have it. If the market itself isn't generating those types of returns, how can they give it to you? So yeah, that's what I would say.
Okay. Uh, Thank you for that. And another question I had was, for people like freelancers who do not have consistent income, how will they approach investing?
Yeah, very good question. So the thing about, again, with freelancers, in fact, financial planning for freelancers is even more important than somebody that has a steady job. Why? Because your income is irregular. So the way that I would approach it is, again, the emergency fund is really important. So you need to sit back and plan and say, okay, if I'm a freelancer and I'm getting 50,000 shillings today, I'm just going to use a random number. I know my job is guaranteed for 3 months. During that time period, you need to do several things. You need to be able to save more than 15 to 20% because just in case of the months coming that you're not going to have money. In addition, you need to make sure that you are already applying for other roles and jobs so that money is income consistent. And then when it comes to investing, you don't. So we encourage everyone to do regular monthly investments, but with the way investing works is that you can put money whenever you have it. It doesn't have to be every single month, and you don't lose your investment every single month. So the idea here is that yes, we'd like you to get to being better, building better investment behaviors. But if you're a freelancer, you can put in money when feasible, and the months that you're not earning much, you don't have to put in money. Shannon, I hope I actually answered your question correctly. Were you getting? Was that part of the second part of the question?
Yeah, you answered it correctly. Thank you.
I do have one more question too. I know that here in the US, we cannot do crypto, but we do have ETFs that we can. Can you talk about that as well?
Yeah, so actually, Annie, the ETFs that I showed you, a couple of them that I mentioned about, actually, you know what? Now that we're here and there's a few of you, let me pull up an account and just show you. So I highly recommend investing in ETFs because the underlying investments in ETFs are shares and they're managed by professionals. So I used to work at BlackRock, the world's largest asset manager. That's why I came back to Kenya and I started Ndovu. But essentially, the Ndovu Money Market Fund at the Ndovu Fund here is not ETFs. These are normal unit trusts in the Kenyan market. But the S&P 500, I'll just put it here, the technology fund as an example. I'll click into this one. So this is a US dollar fund. It's a technology fund. The risk level here is cautious. And if you just see how it performed over the last year, it generated 23% return on the dollar. So this means that if you had invested $1,000 or let's say $100 or $50 into this fund, that $50 would have grown by 100% over a 3-year period. And in 5-year period, it would have grown by 125%. And when you invest in this fund, the idea is you're buying a basket of companies, and these are all technology-related companies. So companies that participate in technology. So you can see some famous names here: Apple, Intel, Visa, Nvidia, MasterCard. And of course, it's not limited to this because this fund has 300 companies. But the beauty of this fund is that this is an ETF managed by Vanguard, which is the second largest asset manager in the US. So it gives you comfort that when you put your money into this fund, they're the largest in the US, second largest in the US. BlackRock is the first largest, but they are regulated, they're monitored by the SEC, etc. So this is a good, this is what it means to invest in an ETF. It's a basket of securities. Now, so going back to crypto, I personally wouldn't. If I'm starting off in investing, I would not touch crypto to begin with. It's not been defined. It's not a traditional asset that works well. It has a lot of highs, a lot of lows. If you're a seasoned investor, yes, you can put 5% of your allocation in there. I hold crypto, but that's because I wanted to learn the market, and I'm very much comfortable that if crypto fails, I'm not losing my whole life savings. And interestingly enough, we deal with a lot of clients who say, yeah, all my wealth is in crypto or stablecoin, and that is risky. And this is why it's important to balance your portfolio. So instead of holding crypto, my advice is you can hold ETFs, which are basket of securities. So for example, microchips, this is a fund that, again, if you look over a 3-year period, has generated 38% on the dollar and 74% in a 5-year period. And it holds companies that are generating semiconductors. And again, it's managed by a well-known asset manager in the US. So the value that I'd say Ndovu brings is that in the universe, there's 7,000 ETFs. How do you pick which was the right one in the microchip space, as an example? So we do that homework. We look at the fund manager, and then we also monitor. And I think one key thing that we're really proud about is actually being transparent. So I'll just take an example of the machine learning fund because it's the first one. It's important to know how your money is growing because it then also makes you think about that. I'm going to spend 2,000 here, but actually it could be growing. So for example, total invested it's a dummy account, so 5,400. Current value is nearly 7,000. And this investment started in April this year, and you're already earning 30% on your investment. And let's say in a given time, you say, oh gosh, I'm up in the profit. So let me just go back here. I'm up here and I've made 36%. Oh, actually, now I want to live off my interest. I'm going to take myself on holiday at the end of this year or whenever you can. And I'm going to withdraw $2,000, $3,000. But you're not taking the money from your capital that you've invested. You're using your income that you wouldn't have had anyways to sustain your lifestyle. And that's why I'm going back to the point of saying, we need to get you to that 13 million shilling mark, which is roughly 100,000. This is 70,000 here, but roughly $100,000, because sitting in the sleep, this money is growing, and I can actually live the soft life. But to get there, we need to make some small sacrifices. Sorry, Annie, I know I kind of went off tangent, but I can't help it. But yeah.
No, you did not at all. It's super helpful for me, especially, since you'll be sending someone to give me a call. But it's super helpful and keeps it into perspective. Because as I mentioned, yeah, I'm in finance world in New York, great. But, I don't know Kenya's market. So this has been super enlightening and in terms of understanding and then also making me say I'm jumping in. so I just want to say thank you so much for coming out to teach us. We will be getting in contact back with your team to, to ask you for more sessions like this at least once a quarter, along with the Women's Investment Club that we're going to pull together. I think that this is wonderful information, and a lot of people think that they have to give this up, but actually, this allows you to have passive
Yeah,
income in the long run, if needed, without you totally demolishing what you've earned already. So, I just want to say thank you for
exactly,
hosting.
exactly.
So thank you for coming out. We will be back in touch so that we can build more people that are aware of how they can make their money grow for the future. Because we're not doing this temporarily. We're trying to build generational wealth. So,
Yeah,
and we can only do it with people such as yourself.
exactly. No, thank you so much, Annie, for having me. Um, yeah, and I hope so. This was useful. This is all I do. I educate people, so I hope this was useful and really handy with some key takeaways.
It's definitely useful. And just so you know, we're going to put this up on our YouTube channel. We'll edit and put it up to our YouTube channel as well as send it to your team. And yes, these things are always helpful and it will be shared many countless times as well as follow up meetings. So I look forward to our next sessions. I thank you so much for joining us today. I thank everyone for coming. But you all have a wonderful day.
You too. Take care. Bye.
Bye.